Well, we're really pleased that we've been able to meet with the famous Dr. Walter Block, noted economist, and maybe he'll teach us a little bit about economics. So, Dr. Block, as investors, should we be worried about inflation when we're talking about the purchasing power of our money? And what is inflation?
Well, inflation has really got two definitions. One, the Austrian economics definition of inflation is increase in the money supply. The ordinary or the mainstream or the neoclassical definition is prices increase. I didn't like the way you began that question as investors, because my view is if I knew anything, I wouldn't tell you. And I don't know anything, otherwise I'd be rich, and I'm not really rich.
As savers, maybe I should say.
Well, as savers, okay, well then if there's, I guess it depends upon why there's inflation. If there's inflation because people are counterfeiting money, as in the Fed, as in Ron Paul wanting to end the Fed, or at least study the Fed, well then savers should be worried, because they're not going to, get much of an interest rate. As right now, their interest payment is, 0.5% or a basis point or two or three,
right,
or something like that. On the other hand, if we were on a gold standard, and the reason prices rose is because gold discoveries were greater than, say, the productivity increases in the rest of the economy, well, that would be okay. Yes, prices would rise, but there wouldn't be any misallocation of resources, which is the Austrian business cycle story. Because for the mainstream and for Austrians, we're all monetarists now. We all believe that inflation, however you define it, comes about by more dollars chasing fewer goods. But where the neoclassical and the Austrian diverge is, we say not only does it have that effect of inflation, it also creates the business cycle by screwing around with interest rates, lowering them below what they would have been. And speaking of inflation, the Fed started in 1913 when the dollar was $1, and now a dollar is worth, I think, 3 or 4 cents or something like that. So that they've dissipated or inflated 96% out of it. And, they're supposed to preserve the value of the dollar. Well, they didn't do a good job.
Haven't done a good job.
No.
And going back to business cycles, can you maybe just explain how the Austrians view business cycles?
Yeah, the Austrians view it very differently than the Keynesians, so probably I should explain both. The Austrians, for the Austrians, the business cycle is not so much too much or too little. It's rather a misallocation. Too much of some things and too little of other things, namely too much higher order goods investment, or long roundabout investments like houses, cars, mines, things like that, that don't come on stream for years, or maybe redwood trees or something in 100 years. Namely, when you have a lower interest rate, what this does is it leads, not only leads, but subsidizes entrepreneurs into investing in heavier industry than the savings rate of the populace would justify. So what we want is not, investment for investment's sake. We want the right amount of investment, not too much nor too little.
Okay.
And here we have too much, and it's not really compatible with the savings decisions of the people. So it's going to, the way one of my colleagues puts it, it's entrepreneurs are counting on 10 bricks, and there are only 9 bricks coming through.
Okay.
Because the savings aren't there. So you're going to get unfinished warehouses or unfinished skyscrapers or whatever it is. Now, the Keynesian view is very different. The Keynesian view is the reason that the market is always, how shall I say it, on the verge of getting either into inflation or depression. And if you get into depression, you have to put the gas pedal on. And if you get into inflation, you have to put the brakes on.
Okay.
Now, there are two kinds of Keynesians. There's the Keynesians, and then there's the monetarist Keynesians of Milton Friedman. And I think they're both Keynesians. And even Friedman said we're all Keynesians now. The one says, well, the brake should be fiscal policy and the gas should be fiscal policy. That's the Keynesians.
Right.
And then the monetarist Keynesians say, well, no, the gas, we agree with the gas pedal and the brake, but the gas pedal should be monetary policy and the brake monetary policy. The problem with both of them is, what about stagflation? Suppose, as we now have, we have unemployment, we're in a depression or a recession, and we also have inflation. I don't care what the CPI says, we have inflation. So what do? Do you hit the gas or the brakes if both are occurring? And Arthur Burns, a previous head of the Fed, was once asked this. This is before stagflation, and he said, "Ho, ho, ho! We'll have to resign then." Well, the whole kit and caboodle of them should resign. Yellen should resign, and Bernanke should. Well, he's already out of it, but so it's a very different kind of a thing for the Keynesian and the Austrian. The Austrian doesn't see any market failure. It doesn't see that the market is always on the verge of going in one direction or the other. The way the Austrians see it is that without government intervention screwing things up, there's a tendency for any errors to be corrected. Like you make an error, you're in a business where you lose money. And you'll be able to make fewer errors because you've got less money to make errors with. And let's say Henri is a great business person and he doesn't make errors and he gets more money. And so the market tends to equalize itself, or equilibrate itself would be a better word. So for the Austrians, there's no inherent tendency that the market is unstable and it's always going to veer off into inflation or unemployment. Whereas for the Keynesians, there is, and therefore government has to play a big role to put gas pedals or brakes on.
And you hear that the Fed has to be there to prevent recessions, or the government's needed, or we need the fiscal policy to get out of a recession. But it sounds like, and what about the argument if we didn't have the government or fiscal policy or Fed stimulation, would we have more cycles or more erratic performance of the economy?
Well, one way to look at this is empirically. If you look at the 100 years roughly before and after 1913, we're 101 years after, but just look at the century before and after 1913. Before 1913, there wasn't that much oscillation. There was a little bit, but that was due to the first bank and the second bank and central banking. But very, very little. The whole panic of 1819, very, very small potatoes. Afterward, the oscillations are gigantic. So if the Fed has the role of reducing oscillations, they're not doing a very good job on that either, in addition to inflation.
Yeah, and speaking of oscillations, a huge one was the Great Depression. Is there something you'd like to say about that in terms of the Austrian perspective?
Well, the Austrian perspective is very different than the Friedmanian perspective. The Friedmanian perspective is that the Fed didn't increase money supply enough. I think that the Austrian is very different. You see, what the Austrian... See, the problem with the Friedmanian view is, why did it start in the first place? All he says is, we had a depression, and then the government should have done this, and they didn't do that, so they exacerbated. But why do we have it in the first place? They have no answer for that. Whereas the Austrian view is, the reason we had that is because of the inflationary pressures in the 20s, which led to unwise misallocation of investment. Look, there was a 1921 depression too. And the 1921 depression was just as big, if you look at it just at the beginning, as, say, the 1929 depression. And yet what the government did then in 1921 is did nothing. Laissez-faire, just sort of ignored it. And what happened in 1929 is not just the, Roosevelt New Deal, it's the Hoover New Deal also. Mm-hmm. It's the Hoover-Roosevelt New Deal. Somehow the Republicans blame Roosevelt and Democrats blame Hoover. It's both. They're equally equal rascals, if you want. What they did is they try to keep wages up. And not just Roosevelt, but Hoover also. And they try to promote unions, and that just created more unemployment. Then you had the Smoot-Hawley tariff, which screwed up international trade. It was just a big government mess, caused by government in the first place. Whereas the Austrians, that's the Austrian view, whereas the Keynesian view is somehow the Depression visited us, and we should have pumped more money in. And we didn't do that in 1921, and we came fine. And then they have this nonsense of, what really ended the Depression was the World War II. Bob Higgs has done great yeoman work on unmasking that one. Yes, if you draft 12 million men, you're going to have less unemployment. But the reason that we did well is not, Henry Hazlitt in his Economics in One Lesson says, if you think that the best way to end depressions or have wealth is to knock down buildings with bombs, well, you know, you're crazy. That's not a way toward wealth. That's a way toward poverty. What really, you know, and the Keynesians thought that in 1945 we'd really be in a super depression because all the men were coming home, and there'd be vast unemployment. But what happened is a lot of regulations were lifted in 45, 46.
Exactly.
And instead of a depression, there was a boom of 45, 46.
And couldn't you argue that a lot of the uncertainty of the Great Depression and you know, the government intervention in the economy from the 30s and 40s, all that went away, the war was over, you know, people were more confident, so
Well,
hence you sort of set the bar so
Yeah.
free entrepreneurs could grow and take
Yeah,
place.
well, I wouldn't say all regulations disappeared,
Okay.
but there was a decrease in regulation, and there was a entrepreneurship, and in the late 40s, it was a boom period, and innovations, and
Sure.
we did pretty well.
Are there any parallels with the Great Depression of the 20s and 30s, or late 20s and 30s to what we're going through today?
Well, I think so. You know, one of the things that the Austrians point to is that the oscillations are much bigger in the producers' industries than in the consumer industries, like, say, Coca-Cola or burgers. They don't go like that.
Okay.
Whereas houses and cars and trucks and things like that, much greater oscillations.
Capital goods.
Capital goods, producers' goods.
Okay.
Right, much bigger oscillations there. And I think only the Austrian explanation can account for that. Whereas the gas and the brake, why should the gas be on this part of the economy and not that part of the economy? They have no explanation for that, whereas the Austrians do, because if you artificially lower interest rates compared to what they would have been based on time preferences or consumer saving investment decisions, saving consumption decisions, well, then if you lower the interest rates artificially, you're going to encourage the wrong kind of investment.
And speaking of interest rates, I mean, you know, the Fed now is this 2% interest rate policy that they're hoping for. You know, why 2%, or why
2%,
even
you
any
mean inflation? Or
inflation?
Right. I think you said interest rates.
Oh, I'm sorry, inflation. So why even 2% then?
Well, they've got this fetish about they want inflation. They want 2% inflation, and somehow deflation is horror.
Is that necessarily true?
No, I don't think that's true at all. Look, when televisions first came out, they were very, very expensive and they were crappy. Now they're much better and relatively cheaper compared to the price index. When computers first came out, they were as big as a house. Now I've got a little computer that's probably as powerful as the computer in the 1960s, and the one in the 1960s cost, I don't know, 10 million, and this costs 500 or whatever.
And so that's good deflation.
Yeah, and when cars first came out, they were very, very expensive compared to, you know, say a workman's annual wage. It was just a toy for the rich. Now, lower middle class people and even poor people can get a used car or a Ford Focus or something like that.
Okay.
So there's nothing wrong with prices falling. Prices falling means consumers can buy more stuff.
Which sounds pretty good.
Yeah.
For voters too, consumers are voters.
But these people, somehow they confuse depression and deflation. Depression is very bad. Deflation is not. And they don't make any sharp distinction between them, whereas Austrians certainly do.
That's a great point. And maybe one last point is, you know, you hear that spending drives the economy. That's 70% of GDP. But I've read some stuff from Mark Skousen that, you know, he says a better way to look at it is, on his measures, the economy, investing is a big portion, maybe 30%. Consumer spending is another 30%. So do we have this wrong notion that consumers are driving the economy when in reality, you know, it's a chicken and the egg? You got to build something before someone can buy it, so you want to stimulate investment.
Oh yeah, no. Mark Skousen is a good Austrian economist, and he's making a perfectly valid point. He's a buddy of mine. Look, you know, the Keynesians, which means the New York Times and NBC and ABC and every economic commentator says, well, it's the consumer who's scared, and therefore, you know, the economy's in the doldrums. Where if the consumer perks up and goes out and buys everything nailed down, then we'll have a good economy. That's just crazy. Look, as you said, production has to come first. We don't eat before we produce. And these guys got it twisted around. They somehow think if you start eating, the production will come about. Whereas no, first you have to plant, and then you have to reap and sow or whatever it is, and then you can eat. You can't eat first and then produce. Look, if the consumer is feeling bad and he doesn't want to, consume, what is he going to do with his money? Well, one thing he can do with his money is stick it in the mattress. If he sticks it in the mattress, prices of all goods come down compared to what they would have been before.
Okay.
And people who do want to spend now, it's called the real balance effect. Now, if you had $500 and prices are half what they were, well, your $500 that you're going to spend is worth a lot more.
It's a good thing, it sounds like.
And the other thing the consumer can do is put it in the bank, and if we had a rational banking system, which is a whole other issue, they would the interest rate would fall, and if the interest rate falls, then certain investments are worthwhile that wouldn't have been worthwhile otherwise. So there's nothing wrong with the consumer taking a hike or taking a vacation, and he has to spend something. He's got to, eat to live. But if he puts a ton of money into the bank and the interest rate falls, well, then we're going to have economic growth. How do you have economic growth without capital? How do you get capital without saving? How do you get saving if you keep consuming? So these guys are just sort of out to lunch. It's almost the opposite of the truth, what they're peddling.
Well, thank you very much, Dr. Block. This has been very insightful, and we really appreciate your time.
My pleasure.
Thank you.